Hello, this is Julius from Basic Financials. Today I'm going to do a fairly short video, I hope. Sometimes get sidetracked. It's to do with sort of inheritance tax, but it's really insurance policy. So what I'm saying here is, if you have gone out and got a life insurance policy, for some reason, might have a mortgage and you might have decided to take out a life insurance policy so that if you were to die, then your partner wouldn't have to rely on their own earnings to they could pay off some of the mortgage. Maybe that's one reason why you might get it, and there are plenty of other reasons why you might have a life insurance policy. Now, the important thing from an inheritance tax point of view is, if you have taken out this life insurance policy and you haven't done anything about trusts, don't worry about that just at the minute, but you've just taken out a pure life insurance policy and not opted for any trusts or named anybody, then if you were to die, that insurance policy, the funds from that insurance policy would go to your estate. So say you've taken out a £200,000 insurance policy and you die, the £200,000 will pay out and go into your estate. And that would be valued as part of your estate for inheritance tax purposes. Now, that may or may not be an issue if you're let's assume that you're over the inheritance tax thresholds. For an individual, that's £325,000 plus £175,000 for your residence, if you're leaving your residence to someone, a descendant, or if you're leaving it to your spouse, then it's not applicable anyway, so don't worry. But if your estate, or that, remember that money from the insurance proceeds will increase the value of your estate, so take that into account. Now, there's one very straightforward way that you could have avoided that life insurance policy forming part of the value of your estate, and that is to write it into trust for somebody. So, for example, if you've taken out your insurance policy so that your partner would get the money to pay off the mortgage, then you would simply write the insurance policy in trust for your partner. Now, because you've done that, the money isn't actually yours or your estate's. It's actually it's owned by the trust, whoever the trustees are, which would normally be the insurance policy, the insurance broker, or sorry, not the insurance broker, the insurance company. So they have this. They would then pay it out to your partner, but it wouldn't form part of your estate for inheritance tax purposes. So that's a fairly straightforward way. Obviously, there's quite a lot of rules about inheritance tax, and spouse transfers to spouses you don't need to worry about them for inheritance tax purposes because they're exempt. But obviously, if you've transferred everything from your estate to your spouse's estate, then they own everything, and that 200,000 might take them over the limit. And so you need to think about what the survivor's estate's going to look like, and you need to do everything you can to make sure that everything's underneath it. So I think that's probably good enough to get on with for that one. So it's insurance. If you've got a life insurance policy, try and get it into trust for the person you want to benefit for it, not just wait till you die and then the funds go into your estate. That's the simple trick. And if you've got any questions or comments, leave them in the box below. And if you could like and subscribe as usual, and I'll see you again for another video soon. Thanks for listening.